Everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Monday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So for today's Monday market update, I wanted to talk about something that came out Friday, a report that came out today, this morning, and then a couple of things on the horizon I'll be looking at this week. So Friday, we had a Michigan consumer sentiment survey, which typically this kind of thing is not a major market mover, but in this case, this was the final version. It came in 10% lower than the previous one, which is a much bigger swing than usual. And things like fears of tariffs, fears of layoffs, is clearly what contributed to that. And it had a major effect. Stock market took a big plunge, and similar to the effect a few weeks back when we had this news of DeepSeek, this Chinese AI company, the drop in the stock market trickled into mortgage rates because as investors are moving away from the stock market and towards more traditional, safer investments like treasury bonds and mortgage-backed securities, that brings the prices down. So it ultimately helped mortgage rates, this survey. Then today, this hasn't really, at least as far as I can tell, moved the needle that much as far as rates, but it's something that is very interesting to me because I've heard a lot of people talk about this anecdotally, and now this story provides some data to back it up. Wall Street Journal story stating that essentially the economy right now, the US economy, is being really propped up to an unprecedented level by the wealthiest, the top 10%, people making over $250,000 a year. They're accounting for 50% of the spending and a third of the GDP, which means a turn in the housing market or the stock market could really cause a significant downturn in the economy. This has been something people have talked about, where we've got this, on paper, really solid economy, very low unemployment rate, 4%. While we don't have ideal inflation, we've seen inflation go down, suggests that it could be kind of a house of cards. While reports like this alone, I don't think are going to really move the needle, it hasn't so far today, it is something I'm going to keep a close eye on to see if there's any indication that top 10% is slowing down or hurting. That could really affect things in terms of jobs and inflation data. This week, the things that I'm going to be focusing on, this Thursday, we have initial jobless claims. That number has been pretty flat lately, but with these reports of layoffs in the government, that number could start picking up. So if we see another number in the 210s, maybe even low 220s, that's not anything noteworthy. But if we see a notable uptick to the 230s or definitely 240s or higher, I would expect that will help mortgage rates and suggest that we're going to see a higher unemployment rate. The other thing, Friday, we have personal consumption expenditures. That's the Fed's preferred inflation metric. And we saw a couple weeks ago, CPI and then the next day PPI really moved the needle. And with PPI, it didn't even, the overall number came in higher than expected, but because the pieces that feed into PCE came in better than expected, mortgage rates improved despite the higher than expected overall reading. So what that tells me is that PCE is really being closely watched by the markets. We see a lower than expected figure. That will definitely be good for mortgage rates. If it's hotter than expected, then that would be negative. Also, while normally this wouldn't be on my radar, we do have a couple consumer confidence surveys coming out, one on Tuesday and then the final version on Friday. With how much of a market mover consumer sentiment was last week, this will be something I'm going to keep an eye out on. And if it is dramatically different than expectations, it could certainly have an effect on mortgage rates, just like consumer sentiment. As always, if you have any questions, shoot a comment below or feel free to call, text, or email me. But thanks for tuning into this video, and I'll see you next time.